All right, I think we are on. Let me do this real quick. Okay. Hold on. Did I even... Hold on. Let me look at the... Hope I got the right... I feel like every time I'm live, I have to look at this real quick. How do I know? Okay, I was gonna do that. I hope I have the right... 1 second, you guys. All right, good. I got the right thumbnail there. So let me open this. All right. Okay. So I'm live right now. Let's go. So today is the eclipse, solar eclipse. And I was watching, as you can see here, it's coming to fruition. So I put GME in the eclipse just to focus on the GME part, right? Of course, right? I invest in the company. Of course, I'm going to be biased towards it. So just so you know that. But yeah, enjoy this eclipse. Now, this is a kind of important eclipse. If you know anything about astrology, I don't know anything. I just watch a whole bunch of video about how important this eclipse is. I'm just gonna let you guys do that yourself. If not, if you're just interested in Gamestop, let's do this. I'll come back to this page here when the time come, around maybe 20 minutes or so, just so that you could see the total eclipse here. Now, in this video, I'm gonna kind of bring your attention to this type of promotion, right? And what I've noticed a whole bunch of time, like anytime they promote something to you on CNBC, you better take a look at it before you invest in it, right? And of course, with this particular segment here, I'm not going to play the sound because I want you to go, I don't want to steal the view from them. But anyway, so if you want to listen to what this guy is telling you to do, is they are presenting insurance company to you, right? Now, I don't have any experience about like investing in insurance company and all that stuff. All my experience comes from Googling things, right? And since I've learned about GameStop, I'm going to apply that to any other company as well. Just keep in mind that that's the truth too, is that the truth of the matter is when I do any analysis, again, I don't have any credential whatsoever. I just Google things, okay? So please consult with the professional if you want the real, blah, blah, blah. So, of course, I was looking at GameStop, obviously, but, I was gonna tell you about this. So, this guy is just telling you that insurance companies are due for a breakout, right? So that's why he's showing you charts and figures and facts, and they're bullish on insurance. They're telling you to buy into insurance company, right? Now there's one company that I'm gonna show you that I have on right here that they told you to buy into. I think, hold on, man, did he mention it in? So this one is progressive. We could take a look at it later too, but within that there was another one, AIG. That's one. We could take a look at progressive, right, as well. Progressive. That's software. I think this is the one. Yeah, PGR. All right. So since he had the chart up there, right here, so he's saying that when it goes grinding like that, it's due for a breakout. And I guess like it was kind of traded up. If I look at it on the chart here, let's go. Trading view. How's everybody doing today? Hello, hello, whoever you are. I think this is a good chart here. Let me. Yes, so this is the chart that he was showing you. Now my indicator right here is called Pluto. As you could tell, I'm into astrology, but it's a sell signal, right? Why is that? Well, if you look at every single star, now it doesn't, pan out exactly so, but yeah, so this is a sell signal too, but in a 4-hour, it's kind of tell you to sell right here. So this is a progressive chart, as he was telling you. I think he had like a weekly. Yeah, that's terrifying. So why is he telling you to buy into this? Is he telling you to buy at the top? And why is this guy showing you since April? Okay, unless this is a different chart altogether. Let me verify real quick. So this is a year from April something. So let me go back here and look for a different one. Maybe that's the problem. Ohio. I wonder why they give you a different chart though. What is this? No, that's not corporate. Yeah, so progressive corporate. The same price as here. Okay, so this is the chart. So since April, why is his chart messed up like that? What is going on, you guys? Am I missing something here? So, okay, this is the chart for progressive. And then this is his chart for progressive. Progressive. Maybe I'm spelling this wrong. Market. Let me call it a network. Let's go to profile. Progressive insurance company provide. Yes, it is insurance company. Yes. Okay, you guys, I don't know what's going on here. Again, this is just me doing it on the fly and I have no idea. But the point of me showing you this is because I want to take a look at the financial of this company, right? And the fact that this chart show a different. Oh, I think this is okay. Sorry. My bad. Now I know what's the problem is. So it was to this is the one. See the peak right here is the peak right here. Sorry you guys. I was saying, am I tripping? Okay, now we know. Alright. So this is the peak. And he is saying that it's gonna go higher, right? Again, I don't know this company that well. That's why we're gonna do some analysis here. We'll see if it's actually true that we should going into this company while it's on a rip like this. You see what I mean? So, and my sneaking suspicion is the fact that they are trying to have you buy at the top, right? Maybe it will run a little bit higher. But again, like, why? Because it's earnings, maybe? Yeah, I'm suspiciously like cautious about this. So should we go the opposite? You know, when they tell you to do something, you might want to do the opposite. So let's take a look at this stat real quick. If you look at, let's see, let me blow it up a little bit so it's, yeah, it's easy to see right here. All right, so this is progressive. Right now it's up last Friday. Hold on one second. All right, guys, I'm gonna step out real quick, so I'm gonna put this on. Okay.
You're watching an annular solar eclipse here on timeanddate.com. We're live from Roswell, New Mexico, and things are, I'd like to say heating up, but they're kind of cooling down as the moon covers up the sun, but we're getting frantically excited here. And I'm thinking they're super frantic up in Oregon in Klamath Falls, because we've been peeking behind the scenes at some images and they're struggling a bit. They're having some technical issues, but they should be able to be watching. They're probably wearing their eclipse glasses, looking at the annular eclipse, annularity, just as we're speaking here, because yes, they do. As far as we can see, they've got some clear skies to see it there, haven't they, Graham?
That's right. Yes. So annularity is underway in North America. We can see from our moving eclipse map, which is on the screen just above Anna and me. So on that map, we have that sort of pinky strip running across the map. That is the path of annularity, the narrow path along which people can see the ring of fire today. And we have that red dot that is slowly moving its way along that pink strip. We say slowly moving its way along. It is moving at a colossal speed. So that red dot, it touched down in the Pacific Ocean. It's raced across to the west coast. It's now making its way from Oregon into Nevada, and just above it we have our telescope feed coming in from our friends at the Exploratorium, who are based in Ely, Nevada. They're getting very close
indeed.
Annularity there. After that, the eclipse is moving on down into Utah, and then it'll be arriving here in New Mexico. Will be the next to see.
We've got our glasses ready, but we're going to be sitting here talking you guys through it as well. So we'll see how that goes.
So yes, the annular eclipse is happening in North America.
It is happening, and there are some things to look for at annularity, because people are going to be out there looking at this. And what are we looking for during annularity, Graham?
Well, one of the big highlights at the beginning and end of annularity is Bailey's beads. Now, people might be familiar with Bailey's beads from total solar eclipses. This is where little beads of sunlight can be seen streaming through valleys on the edge of the moon's surface. The difference between a total eclipse and an annular eclipse is that in a total eclipse, these beads can be seen on the leading edge of the moon at the start of totality as it crosses the final bit of the sun. In an annular eclipse, the beads can be seen on the trailing edge of the moon. It's the trailing edge that is the last bit to cross the edge of the sun and form this ring around the moon. So yes, that is one of the highlights to look out for at the beginning of annularity.
Cool. And we're waiting. We're excited about annularity.
All right, guys. I'm sorry about that. To step down, step out a minute. All right, so hope you enjoyed that eclipse. Of course, we still have a couple more minutes, maybe, to experience that total eclipse. But anyway, so as I was saying about, sorry about the background noise there, my dog's going crazy. So where were we? Well, let's start from the beginning, huh? So this is Progressive Insurance, and then on Friday it was up 8%, right? So that's why you see that jump right here. Boom. Please ignore my dog. It's just going nuts right now. So that jump, perhaps it's some earnings and all that stuff, right? We don't know. Consumer sentiment survey, banks earning, leave equity, stock mixed, late afternoon. Silver miner, Instacart, and da-da-da-da. So I think that's just giving them like... But anyway, so look at this. There was a surprise earning of... so the revenue went up 1%. That justified for this stock to jump up 8%. That makes no sense whatsoever. And then if you look at the top there, earning actually went down 4%. So how is that making sense at all? That the stock went up 8% on a this type of miss, right? So they miss earning, but they increase in revenue. Now maybe there's a forward expectation of an increase in price, right? That could be the reason why it's up. Sorry. So do you think if this is GameStop, you think GameStop would go up 8%? Of course not, right? So again, they could just make it go up, make it go down at will. It's not a free market the way that you think it used to be. But anyway, so I might be biased in this because, again, anytime CNBC is telling you to do something, you might want to think twice before you do that. This guy are putting in front of you for a reason, okay? So that's why we're here. So, okay, so if you look at the market cap, obviously it's $90 billion market cap. Pretty big company there. Dividend yields, obviously they're paying out dividends. Let's see, the rate of dividend growth, negative, close to 80%. I don't think that's a good payout rate, only 13% at a time. Now keep in mind, they want you to buy into this, okay? What other one? So beta, obviously if the market goes up, it's up. This is what it means, positive beta. Relatively strength index, up to, kind of high RSI, meaning that, it's time for you to sell. It's not always like that, but, that's what it means. It's too strong. In relation to it was before, meaning like oversold condition, right? Now they might still have time or have a little bit more, like typically it's around 80 to 85. That's when you kind of want to start thinking about selling. Sorry about that. And okay, so 52 weeks, it's been up 26%. Keep in mind, that's, you're buying at an all-time high right now if you're buying into it. So of course they want you to buy into it, right? When it's like highly inflated already, right? So, and then the float, about half of what GameStop is. Look at this. You see, like I had a sneaking suspicion that that's what it was. Ownership, inside ownership, less than 1%. Of course they want you to buy into this. Look at this. 87%, right? Institution is trying to dump this onto the public. Okay, allegedly. Short interest obviously is very low. That's, I guess, a good sign. Who knows? What else? Now, earnings, price to earnings ratio, less than 10 is good. This one is terrifying, right? Not terrifying, but I've seen higher ones. 50. Now remember, we want it under 10. We want this under 10. Excuse me, 1 second. Sorry, I have coffee here. Okay. Price to sell, not too bad, but we want it to be under 1, remember? Price to book, not too bad, around 5. I think GameStop is around 3 point, close to 4. This one, GameStop was 17. This is actually lower than GameStop. That's pretty good. PEG ratio is good, under 1, so that's good. Revenue, wow, that's a lot. If you look at gross profit, operating income, $2 billion, net income, positive, that's good. Love that. I love to see that. Okay. We want this to be under 10, remember? Price to sell under 1. That's okay. Not the end of the world. But if you look at the balance sheet, hold on, let me look at this real quick. Debt to equity, not too bad. They have less debt than equity. That's good. Under 1 is good. This one kind of concerning because they have more debt than earnings before interest and tax, depreciation, and amortization. See? So, yeah. Debt to cash flow, this is good. Interest coverage, this is amazing, right? Anything above 3 is good. 1 second. Alright, that was my mom showing me this. So yeah, cheers. There you go. Eclipse, it's happening. Jimmy's gonna be hitting the moon soon. You know, I appreciate no one's watching me. No, I'm just kidding. I'm sure you guys gonna watch it later on. So yeah, you know, cheers. May we live long, prosper. Hopefully there's no more conflict going on, and yeah, may us all be at peace in this. Okay, so let's go back to this. Okay, so with Progressive, I mean, it's not the worst company that I've seen, obviously, right? Capital expenditure is lower than the operating cash flow. That's good. This is what concerning to me, right? Net cash position, they are in the negative $6 billion. Okay, what does that mean? It means that they will need cash. At some point, they're gonna need cash immediately. And where do they get it from? Usually, it's shareholder equity, right? So let's go and look at the shareholder equity and see what it is. Now, I like to do a trailing 12 because, again, this account for 12 months from previous quarter. Obviously, cash grow down 20%. You see, like, anytime you have this going on, it means that they need cash immediately, right? Quick. Wait, hold on, let me look at the quick ratio real quick. Did I even see that? Should say quick ratio right here. Oh, it's, of course, it's not it is not. Okay. So right now they have more asset than liability. That's good. Total debt. Look at this. From last year to this year, they increased their debt by $500 million, $500 million up. Last year, they have pretty good shareholder equity. That's good. That's a good sign. They need cash, net cash position. So what does it mean? It means an indicator of a financial position of a company. It calculates by taking the total amount of cash and cash equivalents and subtract it to the total debt. So if they do that, they would be in the negative $6 billion. So my thought would be they are going to dip into either shareholder equity or cut some other expenses, right? Returning earnings pretty good. It's been $16 billion. Wow, that's pretty good. I'm not knocking this at all. Book, so $28 per share. If you look at the book value, so if you do the math right here, 28 when you divide it by the price right here, up there, what would you get? That's 18%. What does that mean? It means GameStop beats this as well. If you do it on GameStop, you would get at least 20, I think 23 now. Hold on, let me do it real quick. So what I just did there is called shareholder equity, okay? If you go GameStop, now, again, like people gonna get at me like, oh, you compare different company to different things. Like, no, this is just a ratio, okay? Like you could compare anything based on a ratio, okay? So leave me alone. All right, so what I did there, so right here, book value per share, boom, 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 divided by the share right here, boom, 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 boom. Oh, 26%. I mean, 20, close to, let's say 28. Huh. Let's be wild and say 28%. So anytime you buy into GameStop, you have 28% equity. That's insanity, okay? You get more money for your value of the company. So even the behemoth out there, right here, that they want you to buy into, at the top, mind you, have only 18%. So that book value is going to deteriorate over time because they need cash to operate more and more, right? So if you look at the operating cost right here, where did it go? Cash flow, maybe? Right here, operating cash flow. It went up. That's good. Hold on, let me see. Expenditure. I think this is the one. So you want it to spend less, okay? So from year to year, it seems like they increase by $10 million of expenses. What's the other one? This is depreciation, compensation. This is share-based compensation, meaning they rewarded their executive and all of the people last year, $122 million worth of stock. Yeah. So they gave themselves a raise, quarter over quarter. I mean, 20%. See, look, from last quarter to this quarter, close to 20% raise on stock-based compensation. So what does that tell you? It tells you that they're going to plan to do this and the executive going to sell out. And this is why you see this. This is why you see this. Share ownership. The minute they get the share-based compensation, they just sell it, right? Now you might say, oh, they still have it. See, that 0.3% is actually them holding. Okay, well, they still add up to be what? $122 million, right? Am I saying this right? Yes, it's in million. So what the heck? Look at the investing cash flow. So either they put money in treasury or lost money or bought some company. So now that the investment just they're $8 billion upside down here, change in investment, whatever that is, right? So you have to go look for yourself. Acquisition, look, 300 million, whatever this is. Investment activity down 177. I wonder if they have any security here. Net cash flow. Okay, 1 second. Sorry. So financing cash flow finally went positive. I wonder what's going on here. Back in 2019, I guess like because of the shutdown, everybody was freaking out, perhaps. But yeah, I mean, all in all, I just think that they need money, and it's high. It's at a all-time high now. So typically you don't want to buy it here. So I don't know. My conclusion is I would wait. I would wait until, I don't know. Hold on, let me see. Here we go. Yeah, so maybe down here. Down here. Well, I would wait until the insider buy into it. Like, if I don't see the insider buying into it, why would I buy into this company? Because it's ridiculous. So that's one. Sorry, it's a long live stream here. It's an eclipse season, so let's go wild. Okay, so and then one of the company that this particular segment pointed out is American International Group, AIG. Okay, it's still an insurance company. If you read about it, insurance products of commercial, institutional, and individual customer in the North America and internationally. It operates through general insurance, life, and retirement segments. So AIG, they were famous in the crash of 2009, right? Remember? So let's see their financial real quick, huh? I wonder if they carry on any more debt since then. Okay. So let's look at the valuation. Enterprise is higher than the market cap. Okay, that's curious. Let's see. Insider ownership, obviously the same. BS, right? Look at this. The institution owned 90% of this company. Of course, that's why they want to load it onto you. Okay, AIG. Okay, so it's kind of rolling. Let's do a 1 week. Okay, let's do a 6 months. What's going on here? Wow. Oh, this is the crash of 2008. See that? Yeah, that is nuts. So from 2000 down to here now. Okay. Wow. What a drop right there. Okay. So, all right. Well, I mean, the chart that's abysmal, right? At this point, it might be a good time to reassess this company real quick. All right, so let's look at the financial real quick. So right off the bat, obviously, insider ownership is none to be seen. So this company is just run amok, right? Well, depends on who is running it now. So I have not done research on those people yet, so we'll see. Now, price to earnings, not the end of the world. Anything lower than 10 is good. Anything lower than 1 here is good. Price to book, that's pretty good right there. So 1 to 1. Okay. Peg ratio is good. Anything below 1 is good. Gross profit, $20 billion right there. Operating income, net income, $4.4 billion. That's pretty good. $6 per share. Close to $1 billion, or 3/4 billion share outstanding. Okay, it's not too bad there. Of course, they want you to buy right here. All the analysts in the world out there. Reverse stock split. So anytime a company is doing reverse stock split, it's not a good company. Just so you know, either they're trying to keep the price up to appear like they're great at doing things. But look at this. Look at the balance sheet. $2.2 billion. Total debt, $24 billion. Net cash, negative $21 billion. And these people want you to buy into this. See that? So, I don't know. I don't know what the justification is, but maybe I'm just too dumb, right? Now, I know, look, the gross profit margin is high. AF, I get it. But the appealing is not this. This is the future projection. Like, you hope this profit margin is going to stay like that for a longer time than this. And this is, to me, it's not a justification to buy into this company because, again, they need cash very, very badly. Now, let me look at the revenue real quick. Okay, the revenue is 50. So, gross profit is $20 billion. Net income is $4 billion. So, if they were to use $4 billion, that net income, the money that they make and pay off debt, what does that mean? It means that now they're not going to do this. They're going to roll it, right? Divided by 4. And this is if they use everything they make to pay off debt. It would take them 5 years. Now, these people are short-term, short-term minded people. What they would do is they would rather go to shareholder equity in order to cash it out so that they could service this debt right here. Keep in mind too, this is in a high interest rate environment. So with that amount of debt, whenever they have to refinance, they have to sell a piece of the company in order to run the company, keep on running the company. Allegedly, right? And this is just me assuming based on the knowledge that I have, which is very little. So 10% return on equity, that's not too bad. It's not too bad. But again, this scary thing is that they need $21 billion to run this company. Hold on. Because if you look at the cash, okay, let's look at the income statement real quick. So as you could see there, you saw 20 billion, and look at the sell, general, and emission went up $100 million every year. Now this year, is that first quarter? Hold on. Oh, this is fourth quarter. Okay, so seems like fourth. This is June to June. If you look at June to June, it went up close to $300 million in cost of doing business, right? If you look at the cost of revenue, look at this from June to June. Look at that. Look at the difference there. Okay, let me do the math real quick. So if you do this number right here, minus this number right here, boom, $3 billion. So it cost them $3 billion more to do business now. And then guess what? Their revenue's down. See that? So that's the metric that they use to pummel the price of GME all the time. So, their revenue is just like, really? Their revenue was flat for GME, but they cut ungodly amount of money here, right? But this company, increase in revenue, increase in cost of revenue, decrease in revenue. They want you to buy into it. Bull, right? Now, I get it, for 41%, that's good. That's a good margin. That is indicative of them having the monopoly over the market. Nobody could offer a better, that's so they think, right? Perhaps they are the leading insurance company, but again, to me, they're in trouble right now. Okay, so let me look at the balance sheet real quick. Of course, they only have $2 billion in cash, and if you look at the asset, they have more asset than liability. That's a good sign. Shareholder equity, that's a lot. That's good. Okay, so let's do the math, just as we did before. Let's do 58.5 divided by that's actually not too shabby there. Better than Gamestop. 95%. Wow. Yeah, this might be a good buy. Might be a good buy. Because they have so much shareholder equity. Now again, this is an insurance company. Obviously, you can't compare it to the freaking retail store. But with that being said, it's a ratio. Okay, it's a ratio. You could compare anything with a ratio. This is the concerning part is the fact that they need cash immediately within a year or so, at least $21 billion. So where are they gonna go to get it? Either load on more debt. Seems like they did pay off some debt down the road here. You look at this line right here, they used to have right there, but with that comes lower profit margin, right? And if you look at the profit margin, where did it go? I think it was an income statement right here. So they used to have higher profit margin, or at some point it was lower too. So I mean, it's not the end of the world, but if you look at the graph right here, and this is gross, by the way, so it will cut into this profit margin right here. This is where we wanted to see, because that's the bottom line, right? So if you're okay with that, as far as share per equity, it's high, pretty steep there. So hey, this might be cheap enough, but I would still be careful because, again, insider ownership is less than 1%. Boom. if it's so good, why wouldn't the insider own something, right? So that's a bigger indicator to me. Okay. And then if you look at the quick ratio real quick, enterprise. So yes, they have less debt than equity, less than 1. That's good. They have more debt than earnings. 2, they have more debt than cash flow. 5 times interest payment. They still could service their debt. That's not too bad there in terms of interest, right? 5 times more likely to do so. Anything above 3, that's good. Yeah, I mean, to me, this is better than Progressive, but again, you know, the name kind of tarnished back in 2008 because of the whole crash thing, right? They might have some debt that we don't know about. Why $21 billion is needed to do that? So it might have something to do with that too, you know. Look, cash, net cash. Yeah, but I mean, they have good income coming in, albeit it's kind of lower than it used to be. Income, you look at it, boom, $50 million went lower. Yeah. All right, guys, it's 10 o'clock. I'm gonna sign off from here, but hey, I'm sorry. This is a very long drawn out live stream here. It has nothing to do with GameStop, but we know what GameStop is, obviously, right? We've watched this all the time, so I just want to do a comparison between these type of, you know, when they put something in front of you, what do? You do the opposite, right? See, like they want you to believe that, oh, it's gonna break out from here. Of course they're trying to pump it, and so they could sell it to you at a high, and then you're gonna keep on holding the bag, right? It's like that's what they're afraid that, you know, GameStop people are holding the bag. That's why they want you to sell GameStop, right? bull, right? All right. So do your own research if you want to invest in these type of company. All in all, though, I think that I would wait to see what's going on in the debt industry. I know we have like a super debt cycle here. Not sure when we're gonna come crashing down, and then we have war and conflict with around the world. So that's gonna, you know, affect the bottom line of every single company, even GameStop as well, right? Because it's a discretionary spending, obviously, and but it's in a gaming industry. It's an entertainment industry. We have a different form of entertainment right now because of video game, and video game has been growing like crazy. You know, 5-6 years from now, you might see even more of a growth because people like me, my age, and you know, the 20s, people in their 20s right now would grow up to play video game as well. So I'm not worried about that industry, and I'm not worried about, you know, the leadership that we have here as GameStop. If you look at the insider ownership, it's like that's a lot. You know, we want it to be more, obviously, and they have demonstrated to us that they've been buying like crazy too as leadership. So again, like, and he's here, like Ryan Cohen is the CEO right now, just in case you don't know that. And he's going to make this company the best company ever, right? Just give them some more time, right? You know, they have partnership with PayPal, buy now, pay later type thing, right? And they expand their catalog. Look, you could buy gaming computer now, any components that you want, monitor and all. Chair, look at this PC accessory, you guys. Oh, do they even have chairs yet? Hold on, look. They have chair, you guys. Look at this. Look at this awesome thing. I wouldn't buy it, but it's a waste of money to me, in my opinion. But hey, if you have the money to spend and if you love the NASA, you know, to have that chair, go for it, man. You know, look at this. Look at the decoration, live stream stuff, computer chair. Look at this Ferrari type of driving game. You name it. So to say that they only sell used game, that's insanity. You know, insanity. Now this chair is not too bad. Look at this. It's twirling too. Look at this, you know. On a budget, if you want to build that studio on a budget, there you go. Anyway, I'm just shopping right now on Gamestop. Yeah, I mean, they have so much stuff, and to say that they just sell used game and those narrative has been stupid, you know. For those of you who have, you know, follow this company, of course they have microphone and all that stuff. They have PC components right here. You could build your own computer if you like. You have a case, you have motherboard, all kinds, you guys. Come on. And they are ramping it up to do that. And I'm sure at some point they're gonna add more. What is it? Table, chairs, all kinds. So I'm not worried about this. Sorry, my dog is going crazy. So on that note, I will sign out and happy Eclipse Day. Be safe, okay? Bye.